Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hi everyone. Adam Bergman here, tax attorney, and welcome to another episode of AdMail. On today's episode, I am going to be focusing solely on Roth conversions. So what I've decided to do, I listen. People talk, I listen. Said, Adam, it would be a lot more interesting if you just picked the topic and do 3 questions on that specific topic. This way we can figure out, do we want to listen? Do we care about this topic? And if we do care about it, we're going to get some more in-depth information. So you talk, I listen. And your wish, my command. So here we go. Roth conversions, AdMail. Let's get rocking and rolling. Without further ado, here we go. Question 1. How does the IRS know the real value of the asset I want to convert? That's from Oscar T. Oscar, well, 2 types of assets, right? If it's cash, it's cash, right? You got 100,000 of cash. I mean, that's what it is. Not that hard to 1099-R and show the amount of the conversion. If you are converting private, something that's not marketable, like not stocks, not crypto, something that doesn't trade on a marketable platform that's 24/7 or readily tradable with an ascertainable value, such as private stock or a private equity investment fund, venture capital, hedge fund, even real estate. How does the IRS know that you're not some way maybe discounting the value of that asset in a way that's maybe not accurate? They don't. That's why they have an audit feature. They don't know everything every taxpayer does. But as a taxpayer, you have to prepare for an audit. So that's why you want to act responsible. Well, in any capacity as a taxpayer, any time you provide any filings to the IRS, you want it to be 100% accurate. So for Roth conversion, same idea. Now, if you have a real estate, you're going to want to look for some independent value, whether it's truly a Zillow, whether it's tax records, a realtor opinion letter. You can't just say, well, I think the property's worth X. No, it's got to be reasonable, right? If the website, Zillow says it's worth 500 grand, and then you convert it at 80 grand, you get audited, the IRS is not going to believe your valuation. They're going to say, get us a new valuation. We don't buy this. Now, why would you take a lower valuation? Because when you do a Roth conversion, you're converting pre-tax to Roth, meaning you're paying ordinary income tax on the value of the conversion. So from the IRS's perspective, they want the value to be as high as possible. From the taxpayer's perspective, we want it as low as possible. So the answer is it's got to be accurate, whether it's in the middle, whether it's on their side or our side. It's what it is. It's what the market is. It's what the timing is. And it's what the details of the transaction are. Now, there are ways to get potential discounted valuations, such as for a lack of marketability. You own 3% of an LLC. You may have paid $100K, but who's going to buy a minority interest in an LLC? Maybe there's other reasons why, depending on the asset, you would get a discount for the valuation, which would help reduce any tax on the conversion. So bottom line, Oscar, you got to act responsibly as a taxpayer, whether you follow your individual tax return on a 1040 or you do a Roth conversion. So you want to look for an independent source to provide the value that's fair and reasonable. Second question from LinkedIn. If I do a Roth conversion, can I pull the funds out right away and use them personally if I need to? So it's a great question. So here's the answer. If you're under 59 and a half and you do a Roth conversion, you have to wait till you're 59 and a half, the Roth's been open 5 years to pull anything out. Okay, even the amount you convert. Okay, which you would think, well, it's converted amount, I should be able to pull it out. You generally have to wait till you're 59 and a half, the Roth's been open 5 years, or at least to 59 and a half. If you are over 59 and a half and you do a conversion, you can pull the funds out at any time because you have that 59 and a half, you don't have to wait the 5 years for the conversion. Pre 59 and a half, you got to be 59 and a half, pull that out. If you wait to 5 years, you can pull everything out tax-free, right? To get a tax-free distribution, it's 59 and a half in 5 years. if you do Roth contributions, you can generally pull that out anytime you want. A conversion has a different rule. Under 59.5, you're going to have to wait till you're 59.5. If you're over 59.5, you can pull it out anytime you want. Each time you do a conversion, there's a new cycle, a new 5-year window cycle that goes in to make sure that whatever you pull out and the earnings, 59.5 in 5 years on all conversions. Okay, so there is a distinction between conversions under 59.5 and conversions over 59.5 in terms of when you can pull the amount converted out. The earnings always have to wait 59.5 in 5 years, but the amount you convert, the actual conversion amount, if you're under 59.5, you're gonna have to wait till you're 59.5. If you're over 59.5, you can pull those conversion amounts out right away. So that's why if you want to do a Roth conversion and you need the Roth money to pay the conversion, because you got to use the money to pay the tax, you only want to do that when you're over 59.5, because you couldn't even get the money out if you're under 59.5 without tax. So it'd be stupid to do a Roth conversion, then pull it out. There's no benefit, right? Because you just pay tax on that money. What's the point? You could have just pulled it out before. So if you're over 59.5, you can pull it out without tax, and just use that money to pay the tax. Although, again, it makes no sense. If you need the Roth money to pay the tax on the conversion, you're just literally taking money from one pocket and giving it to the other. There's no tax benefit. It's ridiculous, right? It's better to just keep that money in the IRA and let it grow versus taking it out and giving it to the government. Makes no sense. If you have personal money to pay the tax, you have losses that can offset any of the tax from the conversion, that's your best solution. So thank you for that question. Third and final question of today's podcast from Bobby W. What is the chance the Biden administration will stop Roth conversions for high income earners? So it's a great question. I did a video on this. The Biden budget for 2025, there's a provision in there to stop Roth conversions for high income earners, someone who makes 450 grand, married, filed jointly, someone who makes 400,000 single. I don't think this will ever pass. I've said it on the video if you watched it. Why? Roth conversions make money for the government. Okay, so why would they stop it? Yes, they think that rich people are gaming the system, but they're not. Rich people who do Roth conversions are paying tax on the value. Now, if the IRS isn't able to catch and aren't able to scrutinize those values, that's their problem. But to just stop the benefit of the conversion and the potential tax revenue for Treasury, I don't see that ever passing. It sounds good on paper. It probably placates the progressive branch of the Democratic Party to show, hey, we're stopping all the rich tax cheats from gaming the system. Although that's not what's happening. The government actually encourages Roth conversions. They encouraged Roth back in 2008 and 9. They actually needed tax revenue, so they allowed folks to do Roth conversions and pay that tax over 2 years in order to encourage the conversion, to encourage people to do conversions to generate tax revenue. For them to just pull Roth conversions out, especially for high income earners that will pay more tax on the amount converted, because they assumably have more money in their Roth if they're high income earners or in their pre-tax IRA, doesn't make a lot of sense and probably is not going to pass any muster and not go anywhere, since Congress is generally only concerned about one thing, and that is collecting tax revenue. So, Bobby, I doubt that's ever going to happen, but great question. That's it for today's podcast. Hope you guys enjoyed it. Thanks for hanging out. It's a weekly podcast. Been doing this, I don't know, about 4 or 5 years already. And I hope you guys enjoyed that. I'm picking questions on specific topics. So this way you could figure out if you like it or not, and there's less surprise, and you could hopefully learn more about the specific topic based off the 3 questions at hand. So thanks again. Hope you're having a great day, and I'll see everyone again next week. Thanks.